Inflation is basically down, and interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
Larry, we have FOMC meetings next week. What do you expect the Fed to do?
I'd be very surprised if they moved interest rates. I think they'll continue to convey vigilance and a sense of uncertainty about where the economy is and their determination to monitor both the cyclical risks and the inflation risks. I think the Fed has to be very careful given all the political pressures that have been put on it, given that the tariffs are potentially going to be an important inflationary impulse in the economy, and also given the substantial signs that the economy is slowing. If I were at the Fed, I would be trying to have an uneventful meeting and not produce any substantial reaction in the markets. And my guess is that that will be their course.
President Trump seems to have a different view. He thinks that they should have cut already, that they're behind on the cut. And there is some slowing in the economy. We saw the GDP numbers, at least for the first quarter, come in light. We saw core PCE actually pretty modest this week. Is there a growing case for what President Trump is arguing for?
I think the economy probably looks softer today than it did a couple months ago, but I think there are also some troubling signs of inflation risk going up. I wouldn't argue with the market's judgment that the full set of developments in the economy points towards more easing than looked like it would be necessary a month or two ago. But I think it would have been a grave mistake to have eased already, and would be a very serious error to ease at this upcoming meeting. I think the results would be a lack of confidence in the Fed's determination on inflation, and that would mean higher interest rates at the long end, and that would mean higher mortgage rates, and would probably ultimately mean more economic weakness. So I think the president's advice is really quite misguided, both as to the substance and as to the appearance. As I've said many times, Fed bashing for a president is a fool's game. The Fed doesn't listen, and so short-term interest rates don't go down. The market does listen, and so long-term interest rates go up.
Talking about short-term interest rates, we had Treasury Secretary Bessent this week say that if you look at it, the short rates are below the federal funds rates right now. And when the short rates are below the federal funds rates, that really argues for a cut. Is that a good benchmark?
I don't think so. The two-year interest rate reflects the expectations of what the future short-term rates are going to be. So all that's really saying is that the market is expecting that there will be cuts. That's not the same thing as saying there should be cuts. So I think it's pretty analytically unsound to reason from the 2-year to what the Fed should do, and it's pretty inappropriate for the Treasury Secretary to be commenting in that way on the Fed. In many ways, it's actually even worse than the president commenting, because people understand that presidents are political figures who are called on to address all issues, whereas they think of secretaries of the Treasury as sophisticated financial professionals who should know all about the independence of the Fed.
The independence of the Federal Reserve doesn't depend on the will of the president alone. Congress set it up that way, and ultimately the courts may have something to say about it. Kathryn Judge is a professor at Columbia Law School and has studied how the Fed has evolved.
So it was actually restructured quite significantly in 1935 to be significantly more independent. That year matters, actually. It was right after the Supreme Court decided a major decision, Humphrey's Executor, which made it clear that Congress was able to create independent agencies. And it was in the wake of that decision that the Congress really restructured the Fed to its current structure. And it's a complicated structure. We still have 12 reserve banks across the different country. But then we have the Board of Governors, and they all serve for 14-year terms, and they can only be removed for cause. And that really serves as the bedrock of the Fed's independence.
There have been times, even in more recent history, when the Federal Reserve seems to have been really addressing the concerns of the president. Under President Nixon, for example, that certainly happened.
Yes.
What were the consequences of that, and what corrected and what gave us Volcker?
Yeah, I mean, I think it was actually what happened with Nixon and Arthur Burns, who was then the Fed chair, that led to the Volcker era, and really what we've had subsequent to the Volcker era, which has been a real respect among politicians for Fed independence. And what we saw there is the classic stereotype of a president who wants a slightly healthier economy in the short run, is putting pressure on the Fed chair, and a Fed chair who felt the need to be somewhat accommodative to those pressures. And the result was really destabilizing. We ended up with a period of meaningful stagflation. So we had high rates of inflation, high rates of employment. It was not healthy for really the economy or for anyone else within the economy longer term. And one of the real challenges then was, how does the Fed reestablish credibility? How does the Fed convince the public, convince markets that it is going to tighten monetary policy even when it's facing pressure to be more accommodative? And Volcker really came in, took the reins, and had that long-term objective, and was willing to cause some significant short-term economic pain and to face some meaningful threats in the process. But he managed to do a remarkable job reestablishing the Fed's credibility.
Recent presidents in general have been reluctant to comment on the actions, particularly in monetary policy, of the Federal Reserve. President Trump has been very explicit, saying, I can say what I want to say. If I want to comment on it, I'm going to comment on it. Can he be free to, I'll say, jawbone the Federal Reserve, consistent with its independence?
I would say that's part of what we're trying to figure out right now. The challenge that we're facing with President Trump is not just that he has an opinion on interest rates. I think it's actually legitimate, and even though it's not been done in recent presidencies, not inappropriate for a president to be able to have a view. The challenge is he's expressing that view while also having taken the position that he has the authority to fire Jerome Powell, the current chair of the Federal Reserve, and while also having removed other commissioners from other agencies that have explicit for-cause removal protection. So it really is that combination of not only having an opinion, but having views about his legal authority that are incredibly expansive, that have the potential to really undermine the credibility and that expectation that the Federal Reserve will be able to maintain the independence that it's enjoyed, and that has allowed the economic flourishing that the country has enjoyed for the last 4 decades.
If we are looking for guardrails, do they come from laws? We like to say we're a nation of laws, not of men. Or might they come from bonds? Because there's been a fair amount of reaction in the bond market to some of what President Trump has said.
I was going to say, I have to say, I've personally welcomed all of those reactions, and I think it's appropriate for a president to be responsive to understanding what the market is telling them about the likely impact and the potential destabilizing impact of policy choices, of threats. That being said, we can't rely on the bond markets alone, and there's a lot of danger in that having be too much of an indicator or too much of an influence.